We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Rafi Farber, author of The Endgame Investor. How are you today, Rafi?
I'm doing very well, Tom. How are you?
I'm excellent. It's great to have you back. And we're going to have a little bit more of a topical discussion today. You recently wrote an article that was entitled "Gold is Money, the Dollar is a Gold Substitute, and Fiat Currency is Impossible." So we're going to focus our conversation mostly around that and really, trying to analyze fiat currency and what it all means. So why don't we start by defining what sound money and hard money are, please?
Well, we could define sound money as an honest measure of value. I mean, what makes sound money sound is what it measures is not necessarily constant because everything changes by supply and demand, but you know what it is. You basically know what the supply is, and it's not radically changing all the time. So the measure, while not constant, there's no such thing as a constant measure of anything. It's predictable. A good money would be gold and silver, because the increase in their supply is more or less predictable. Sometimes there's, a huge gold rush or a silver rush somewhere which disturbs prices now and then. But over time, it's a stable medium of exchange. Now, the problem with paper money is that it's supposed to be a substitute for gold and silver. That's how it was born. But what happens eventually is that whoever makes these substitutes makes more of them than actually exists. And then people, especially before they had access to the internet or to, communications, and they could know the money supply or, let's say a central bank published it before anybody knew this, there was just more money around. So then it would affect business because this is the circulatory system of the economy, you could say. So, the more gold substitutes that are printed above the gold money, which is the hard money or the sound money, then the entire price system goes out of whack and people go into debt that they can't pay back. And when these debts cannot be paid back, then essentially the lie that is the inflation of the gold substitute over the actual gold supply becomes exposed all at once. And then the entire price system has to shift back to what it was, and that disturbs a lot of business calculations. It's another way to see business cycle, or the Austrian Business Cycle theory, just another way of putting it, right? So another example, let's say in the New World, in the Americas, when the silver mines and the gold mines started coming online in Mexico and then moving to Europe, you had a huge influx of gold and silver, of real wealth going into Europe from North America for the first time. And that made things a lot more expensive because the real money supply was going up. People call this inflation. It's not inflation. It's the lowering of the purchasing power of hard money, of sound money, because there's more of it, because it's coming in, and that happens sometimes. But how does the free market deal with that? Well, some people lose in that instance. People who've been saving, they do lose some purchasing power, and it's not great. But it becomes unprofitable over time to mine more gold and silver because the cost of mining this stuff goes up, and the stuff that you can buy with the gold and silver that you mine goes down. So it's not profitable any longer to mine it. So you stop mining it. And then the supply kind of steadies out, and then the supply of goods and services goes back up, and then prices slowly but surely come back into a balance. Why isn't that inflation? Because what happens when inflation is revealed, right? When all of a sudden everyone's in debt because there's so much money supply that you can afford to go to debt, and because the more money supply, the lower interest rates. Eventually, when the dominoes fall and the first person cannot pay that debt, and that affects the second person who's in debt to that, it keeps falling. All these lies, the inflated gold substitute supply over the real money supply, they become revealed very, very quickly. Not all at once, not in one day, but maybe in a few weeks, a few months, and then the whole price system changes in that very short amount of time. And that's sort of what happened in Europe with the influx of gold and silver, but over a much shorter time frame, and it really disturbs things. So that's the difference. We'd say sound money versus gold substitutes.
Excellent. So, Rafi, something that you were mentioning there is let's say the difficulty of mining gold and silver. So can you tie that back into the definition of hard money for those that don't know it?
Well, hard money, it's just gold and silver. I mean, it's something that maintains its value no matter how many times you divide it. I mean, if you take a gold coin and you melt it down and you make it into 2 gold coins, the value of the 2 gold coins is the same as the single gold coin, or almost the same. Whereas a diamond or something like that, if you split it, it loses most of its value. So you need a hard money that can be divided and track the values of things, of goods and services that are being exchanged. Now, the point that I think is really important about this is that we go around using the term fiat currency. And I have this memory in my macroeconomics class in high school. I have these moments where things were said to me and I remember registering that doesn't sound right. And then they only come back to me as an adult saying, yeah, that wasn't right. But one of them was economics teacher was explaining that the dollar used to be backed by gold, right? But now it's not. And she said, now it just has value because the government says it does. And then I was thinking, how can the government just say a dollar has value and therefore it has value? Because if that was true, then there would be no such thing as hyperinflation. It would never happen. Because why would a government suddenly say that their money has no value? Obviously, it's not the government saying that fiat currency has value. There's something else there that's making it have value. So it all goes back to Hayek, who's an Austrian economist, Austrian school economist. And he says his one discovery in economics was the price system is a system of signals that brings people into a working order, right? You wake up in the morning, you know basically how much money you have to make, how much money you have to spend, how much you have to do in order to buy the things you need to buy and sell the things you need to sell. And you know all this information when you wake up, right? How does that happen? Well, supply and demand of all the things that exist in the world. Everyone in the world has to know how much of stuff there is and how much people want of that stuff in order to make society work. The information that we have that tells us how much of something there is and how much people want it is the price system. That's how we divide goods and services. That's how everybody lives. It's something, if you inflate the money supply, it goes all whack. Some people get poor and some people get richer off of that. But that's what we need. We need prices to explain to everybody who's working in the economy what they need to do to survive and what other people need them to do to survive. Now, if we plug this into, there's a famous theorem that's passed around in Austrian economic circles by Ludwig von Mises. It was the regression theorem of money. So he says, how does money get its value initially? So he traced it back to, basically when you wake up in the morning and you have the information, how do you know how much things cost? Because you have an idea of what they were yesterday. You always index it to something that you had an experience of in the past, right? And the day before that, it goes all the way back into the past. So how did money form initially? And very early on in human society, people started trading gold and silver as useful metals because you could make stuff out of them and it was pretty and people liked to buy them or like to trade for them. And they would trade it for goods and services, for food or for houses or, whatever they needed back then. And eventually a price system was able to formulate itself based on ounces of gold and silver. And so it started from barter, right? So
it's a more efficient way of transacting than bartering one cow for 10 fish or whatever, right?
Yeah, there was no plan. There was no plan by anybody. Oh, let's make gold money. Nobody planned anything. It's like Milton Friedman said about the pencil. Nobody planned a pencil. Nobody planned on how to put the wood together and how much this would cost. Now, it just came together because the supply and demand of the various things in the pencil created this demand for a pencil, a writing utensil, and it just happened. So there's no plan to make gold and silver money. It just happened and made trade easier. Then what ended up happening is that people didn't want to carry this around anymore. So they gave it to a storage company to store. And the storage company would give them paper, instead of the gold and silver. Then what happened is the storage company could figure out that they wanted to buy stuff for themselves and become a bigger business, make more storage companies, make more money. So they would just print more of this stuff and then buy things with it and not tell anybody that they were doing this. So that's how inflation started. Now, if we picture what happened in 1933, 1934, let's say, right? In the 1920s, the roaring 20s, the reason it was roaring is because the money supply was going through the roof. If you read Murray Rothbard's book, America's Great Depression, you see the dollar supply or the gold substitute supply really going through the roof then. And then what happened is, at some point it couldn't keep going because people were calling in their gold instead of substitutes. And then what happened is everything crashed. Yeah.
Rafi, something that I'd like to maybe get your clarification on is, if anybody has watched The Hidden Secrets of Money, the great Mike Maloney, I will say, makes a very interesting distinction between currency and money. Do you follow that same distinction? And what is the difference in those two terms to you?
I'm familiar with that distinction. I do follow Mike Maloney. I haven't watched all of his videos. But I think we're getting at the same point here. See, according to Mises, there is a money. It must exist because it must be tied to the past. It must be tied to the origin point of all economic transactions that have ever happened. Now, currency is a representation of money. It can be an honest representation of money. It can be a dishonest representation of money. But a paper dollar or a digital dollar, whatever you have in your hand or on a computer, is not money because it must be referenced to the past, and the past goes all the way back to the origin of money, which is gold and silver. So that distinction is there. Let's go into this question. When we call fiat currency, is that even possible, right? So if Mises says that all money goes back to the origin point, because otherwise you wouldn't have any information about what things really cost and how much resources you have if you don't have a reference to the past.
So, Rafi, when there was too many notes issued for the amount of gold that was held in these banks at that time, what happened in 1934 and then again in 1971?
So it was 1933, 1934, right? So there was all this inflation that had happened. The total amount of dollars, which were gold substitutes back then, right? There was a lie that gold could be substituted for $21 an ounce. If you take all of the dollars in America and you substituted them for the gold supply in the United States, then you could substitute all gold for $21 per ounce. And that was revealed to be a lie. That didn't work. So instead of deflating the entire gold substitute supply, FDR put it back up to $35 an ounce and then had everyone sell their gold to him or, by force, and took it all to Fort Knox. And then at that exchange rate, it was more or less true. We don't know exactly what the dollar supply was relative to $35 an ounce. It was around there. And then it kind of worked. I mean, there was a big bump in the road. We call that the Great Depression and all the government intrusions that happened in those 10 years. But eventually everything, kept going. People still were able to eat and survive and society went on. You see, when the dollar was trading for $35 an ounce between 1933 and 1971, right? What the government was saying was that the real money supply, which is the gold supply, you could exchange that for all the dollars at $35 an ounce. But that would be impossible from 1933 to 1971 because the amount of gold that was mined, from that time was not the same as the amount of dollars that were produced over that time, which was much, much more. So this was a huge lie. But still, the fact that you could trade dollars, you could trade gold substitutes for some amount of gold meant that the link that Mises said at the beginning of monetary history was still alive, right? And that made the monetary chain still relevant and able to make a price system make sense in terms of goods and services that you could trade. Except in 1971, central banks who could still trade dollars for gold caught on to this, and they started redeeming the gold and trading the gold substitutes in for it. And then what did Nixon do? He actually did something kind of honest. He said, we can't do that anymore, so we're not going to trade at $35 an ounce. But libertarians and the hard money crowd makes a big mistake at that point. It says at that point, the dollar became a pure fiat currency. What does fiat currency mean? It can't mean that the government just says it has value, because you can't just say something has value. Otherwise, it doesn't convey any economic information. You have to say how much value does it have. In order to say how much value something has, you have to know how much goods and services there are and how much people demanded these goods and services versus how much money there is and how much people demand this money. There's no way that a government could know all that information. So it's not fiat, right? The US dollar is still a gold substitute. Why? Because you can still take, let's say, $1,830, whatever it is today. You can still take that amount of cash, that amount of money, credit, however you want to spend it, and you can get an ounce of gold. You still can do that. And the reason that the dollar can buy anything is because it can still buy that ounce of gold. Now, there's empirical evidence here that the minute that any fiat currency can no longer be traded for any amount of physical gold, that so-called fiat currency, or that gold substitute, more accurately, is dead. Because in every single hyperinflationary economy that's ever existed, at the point where hyperinflation kicks in and the value of whatever currency it is goes to zero, you can no longer buy any amount of physical gold with that currency. What that means is that the currency is no longer a functioning gold substitute, and anything denominated in that currency becomes meaningless, and there is no economic information, so people stop using it. That's what happens when a currency hyperinflates, right? It's not being rejected as a fiat currency. It's being rejected as a gold substitute. The proof is that you can no longer buy any gold with it. You can no longer exchange it back into gold. So we say that Nixon closed the gold window. He didn't close the gold window. He just made it more honest. He said, I'm not going to pretend that this gold window still exists at $35 since it's so obvious that it does not. So I'm just going to let the free market put the gold window at whatever exchange rate it wants to. And good luck. That's what he said. So we said we don't like what he did, but it was more honest than keeping it at $35 an ounce. He did what he had to do. He could have deflated everything back down to what it was in 1933. That would have been a massive depression and politically impossible. So he did the best what that had to do. So really, we're at the end of a bubble here that if we assume that FDR was right, basically, or whoever was advising him was right, and that the dollar supply at the time, 1933, was about $35 an ounce exchangeable. That was the monetary exchange rate. Then we're at the tail end of a bubble that started at that point. And, we're now at 1,832 an ounce. But if you ask the question, do you think that if everyone who had dollars wanted to exchange it for gold, how many dollars would they need to get an ounce of gold? It's probably something around 50, 60,000 at this point and climbing. 21 to 35 was a big depression. But imagine the exchange rate, the depression that would result from gold moving from $1,832 an ounce to 60,000 overnight. That's what's going to happen, and it's going to happen by the free market, like it did in 1980.
Rafi, how are you coming about that number? Are you saying that the money supply has expanded by that much that it should take $50,000 to $60,000 to buy an ounce of gold?
It's very simple how I'm coming to the number. I get this from Daniel Oliver. He's the head of Mermicane Capital. Mm-hmm. It's a gold fund, but he has the most concise, logical definition of what a gold standard is, where a gold standard is. He takes the entire Fed balance sheet. The Fed balance sheet, it's a balance sheet. It's balanced between liabilities and assets, right? So the dollar is defined as a liability of the Federal Reserve System. The Fed balance sheet right now is 7.6 trillion, 7.8 trillion, I don't even remember. So 7-point-something trillion dollars. And the amount of gold in Fort Knox, supposedly, is about 8,132 tons, if I remember correctly. So there is some gold on the Fed's balance sheet. It exists. Now, if we are going to go back on a gold standard, then that amount of gold that's on the Fed's balance sheet is going to have to back 100% the rest of the dollar liabilities that are on that balance sheet. So if we have 8,132 tons, what is it, 200? I've done this calculation a few times, so I remember the numbers. I'm not a genius. So I think it's 235 million. I might be way off, but these are the numbers I remember. 235 million ounces, divided by, so 7.8 trillion divided by 235 million. It's something like $40,000, $50,000. It's somewhere in that ballpark. So if you go back to 1980, right, the gold price went to, $800 an ounce, $870 an ounce. And if you divide the number of the Fed's balance sheet at that point by $872 an ounce and the same amount of gold in Fort Knox, you come up, it was over 100% backing of the Fed's liabilities. So that's the number we're headed for, but it keeps going higher because they keep printing more and more and more. So eventually the dollar, what's going to hyperinflate the dollar? What's going to hyperinflate it is when the free market itself, meaning you and me, everyone who buys physical gold now, our job is to actively close the gold window. We want to close it. Nixon didn't close it. Why do we want to close it? Because we don't want them to be able to extract value of that gold from us anymore, of that money. They extract, when the government prints money, they're not creating value. They're extracting value that already exists. Where is that value? The value is in the dollar as a gold substitute. The value is not in the dollar itself. It's not in the size of the American economy. It's in the viability of the dollar as a gold substitute. Once the dollar is no longer a gold substitute, they can print trillions of as much as they want, and they can no longer extract any money from the public. So our job is to close the gold window for good and not remonetize gold. We don't want to remonetize gold. Gold is money because the dollar is a gold substitute. It's not a fiat currency. Fiat currency is impossible. It is a gold substitute that we want to demonetize as a gold substitute and return to gold, or an honest substitute for gold instead. So our job is to demonetize the dollar, not to remonetize gold.
So as you're talking about inflating the dollar supply, Rafi, and extracting the value from the currency by this inflation, what happens when that value extraction or inflation point reaches a rejection point?
So we know what happens. I mean, we've seen it happen. We've seen it happen in many, many countries. What we've never, ever seen, and what we are about to see, whether it's a few months or a year or two from now, I never know. But it's getting closer, and it's definitely happening, that I am sure of. What happens is that people's goal becomes first and foremost instead of buying the things they need. It goes in two stages, and Mises talks about this in the theory of money and credit. The first stage is people want a monetary reserve to protect themselves against the future, right? You never know what kind of expenses you're going to have, so you always keep some kind of a monetary reserve somewhere. The next stage is, instead of just buying what you need or you want now, or you want it to satisfy your needs and wants as a human being, and I don't care if you're a spendthrift person or you're a very frugal person, everyone has the amount of money that they think that they want as a reserve. There's always something. But the next stage is that instead of only buying stuff that you want or need, you're going to buy stuff that you want or need in the future, that you know you will need later, because your fear of the price is going to go up. And what does that do? That increases the amount of money that's being spent, because it lowers the amount of cash balance that people want in their accounts. But then that just pushes up prices higher and higher. And then what happens is you reach the third stage. People stop buying what they want and need, and they just buy anything they can get their hands on. The goal becomes to just get rid of the money substitute as fast as possible. So as gold and silver stackers, physical gold and silver, what we're doing is we are sort of front running this. We know what's going to happen. We do not know exactly when. So by front running it, we're saying we see where things are going. We're going to get real money now because we know that the dollar is a gold substitute. So let's just get the real stuff now. And then, when the value of the gold substitute can no longer be substituted back into gold, then what's going to happen is that, in countries like Weimar in Germany or in any other country where hyperinflation hits, the value of real money in terms of its purchasing power goes through the roof. In Berlin, and Alistair McLeod talks about this, in Berlin, in late 1923, you could get like a really nice place in, the rich side of town for about 4 or 5 gold coins. And you could go in with dollars, which were gold back then, relatively, and just buy and just, have a party with a dollar. But why is this? Like, what is this reflecting? It's reflecting the fact that there is no monetary medium in that country, and one is desperately needed to exchange, because you can have as much technology as you want. You can know how to make food, you can know how to make tech, you can know how to make houses, but you cannot do anything if you cannot equitably divide value in goods and services with the medium, because if nobody knows how to trade anything, nobody can do anything, and then you starve. So the monetary medium is going to be in humongous demand when the gold substitute dies, and people are going to be left with substitutes. They can't buy anything. So it's going to be our job to reintroduce this monetary medium for desperate economies that need to be able to exchange with each other. So yeah, are we going to get rich in real terms of the process? Yes. Do I feel kind of guilty about that? Less and less. It doesn't make me feel great. I'm not looking forward to just ripping people off by giving them a silver coin and getting a car. I don't know if it's going to get that bad, but it's going to be pretty crazy. So this is going to be our job, and if we get rich doing it, then so be it. But we're going to be reintroducing the real monetary medium in economies that desperately need it, and you can either be part of it or you can go buy Bitcoin.
We'll get to the Bitcoin thing, Rafi, but Before we get there, you point out in the article that there's 2 distinct categories of currency. So what is this distinction?
2 distinct categories of currency. Oh, okay. So there are bona fide gold substitutes, and the dollar still is a gold substitute, assuming there is gold in Fort Knox. You could say no, you could say yes. I don't know. I'm just assuming yes. So the dollar is a gold substitute. You also have central banks that have their own currency supply, that manage their own currency supply, that also have gold in their reserves. So they are also gold substitutes. So when you're talking about the euro versus the dollar, you're talking about relatively different relative inflations of gold substitutes. But there are also banks, central banks in the world, and you live in one of those countries, Tom. For example, Canada, and also where I live, Israel. The Bank of Israel has 0 gold, 0, in its reserves. So then how does the shekel have any value? The answer is because it is a dollar substitute, and the dollar is a gold substitute. So the value of the shekel, or the value of the Canadian dollar, rests exclusively on the dollar's ability to be substituted back into gold. Now, you and I can, we can gripe about that. We could, picket the central bank and tell it to buy gold and blah, blah, blah. And, I used to be on that side, but now I'm thinking, we just talked about how valuable in real terms a real monetary medium will be when gold substitutes are no longer accepted as gold substitutes and all the value has been extracted. In countries where central banks have 0 gold supply backing their currencies, can you imagine how valuable in real terms a real monetary medium will be in your country, in my country, when the SHTF, it's going to be much more valuable than in a country that could theoretically freeze its currency and make it exchangeable. Let's say, in America, in the United States, let's say there's a crisis and then the Fed says, okay, dollars are now exchangeable 1 to 35,000 and we're lopping off 3 zeros. We're going to go back to $35 an ounce. It's not like this hasn't happened before. It happened in Israel in 1984. Good year. It's a very Orwellian year. They had there was the shekel, and then it started hyperinflating in the mid-1980s because the central bank was funding the government deficits directly. It was rejected as a dollar substitute. And then what happened was they locked 3 zeros off, just like they would lock 3 zeros off if the dollar goes to 35,000 and they want to go back to 35. And then what happened was, people lost their savings. Everyone started out. It was Fight Club again, and life went on. Life went on because you could re-index to a dollar, which was still indexed to gold. Now, the question is what happens when the dollar collapses? And, if there is gold in Fort Knox, if America really does have gold reserves, then everyone would lose most of their purchasing power in dollars, and it would go down, 1,000 to 1. But the people with real money would suddenly be extremely rich because we'd be able to exchange our gold back into whatever new monetary medium, or you could say there would be a complete breakdown. If that's true, then you'd break up into private monies. That's also a possibility. I don't know exactly what's going to happen. I just know it's going to be chaotic. And the more the government tries to interfere, the worse it's going to get.
Rafi, something I wanted to push back on you a little bit in regards to the Canadian dollar and the shekel, as you were mentioning. Theoretically, those can be still exchanged for gold, can they not? If you're not necessarily exchanging it with the central bank, but you're exchanging it with somebody else for gold, does that not give them, value as a gold substitute?
It's a good question. So, empirically, when you're making an economic transaction of shekels into gold or Canadian dollars into gold, that works. You don't have to change it into dollars first. But if you think logically about what you're doing and you take Mises' regression theorem as logically true, that everything has to trace itself back to the origin point of money or else prices are meaningless, then what you are doing when you're trading Canadian dollars for gold is you're taking Canadian dollars, you're exchanging it for American dollars or any other currency that is a gold substitute, and then from there, you're getting your gold. It's just you're not seeing that part of the transaction, but it must logically be there, right? Here, if we can transition into Bitcoin, and look, disclosure, I own some Bitcoin SV, BTC, I own some Bitcoin SV, that's a separate issue, but just in case Craig Wright is Satoshi Nakamoto, I have no opinion as to whether he does or doesn't. I don't follow any of this stuff. But if he is, and he claims that he is, and he's the guy behind Bitcoin SV, then he's trying to prove it in court. Whatever. I own this stuff because I see there's a speculative value to it. But when Bitcoin was founded, how did anybody know what it could buy? They started an exchange rate with the dollar. That's how it started. Right? So Bitcoin is a dollar substitute, just like the shekel or just like the Canadian dollar. It's a substitute for the dollar, which is substituted into gold. So when the middle link of that chain collapses, meaning when dollars can no longer be substituted back into gold, then, let's say Bitcoin goes to $1 trillion, $2 trillion, $3 trillion. It doesn't matter because no amount of dollars can be exchanged for anything. So people who are going to need gold are not going to need Bitcoin. You could say that Bitcoin would be directly exchangeable for gold. Maybe. I don't know if that's even logically possible or empirically possible. But if you want to bet your wealth on that, your entire life on that happening, I don't think that's a good bet. You could bet some of it, and that would be fine, speculate, because maybe it'll happen. But what you can be sure of is that gold will become the direct monetary medium again once the shit hits the fan.
Mm-hmm. So another interesting point that you bring up in the article, Rafi, is that gold is not a competitor to the dollar. Why do you see that?
It's very simple. Because the dollar is gold. It's just a very inflated substitute for gold that has an incorrect exchange rate monetarily between itself and gold. Right? The dollar can't compete with itself. The dollar, if the dollar only has value because it is a gold substitute, then you can't say that the dollar competes with gold. You can say that the inflation of the dollar over the gold supply becomes more and more revealed the higher the price goes. And that's all we're trying to do. We're not trying to collapse the dollar. We're trying to reveal the true monetary exchange rate between gold and its substitute at a 100% parity. That's what we're trying to do before any of this inflation stuff happened, when money was honest, when people knew what the money supply was and banks didn't print extra units of gold substitutes. That's what we're trying to do. So a real competitor to gold as a monetary medium would be silver. That silver is a competitor to gold. And you see that the exchange rate between gold and silver is always fluctuating. It's always going up and down. There's an equilibrium somewhere that was much closer to 15 before all this inflation started. But now it's like 66 and it goes down to 15 and it went down. That's another interesting thing. We're talking about 1980, right? When the free market, according to Dan Oliver, put the dollar back on a gold standard by backing all the Fed's liabilities on its balance sheet. Where was silver at that time in 1980? It was at a 15-to-1 parity with gold, which was historically the very long-term exchange rate between gold and silver. So yeah, silver is a competitor to gold as a monetary medium, and the demand and supply between those two metals is always fluctuating, as competition should be.
So is this why we've always heard that the banks are manipulating the prices of gold and silver?
Yeah. So if we see what's happening with the banks and how they manipulate the price of gold and silver, I'm not of the camp that even thinks that they're doing this consciously. I don't take a position on that. That's more for, investigative journalists like Chris Marcus to go and harass the CFTC and all this. And maybe it's happening, maybe it isn't, but I don't think it's relevant. Aside from getting attention and, bringing consciousness into this, it's important to try to reveal it. But I don't think it's a conscious thing. You see, from, let's say the 1920s, 1930s, or for even up to the 1970s, the government would lie and say gold is exchangeable with $35 an ounce, right? And it wasn't, because they kept producing more dollars and not producing as much gold. So the exchange rate in the real market was going higher and higher, but they kept saying 35, right? So it's the same thing that they're doing now, right? The manipulation is the fact that the notional amount of shorts in the futures market for gold is much higher than the actual gold supply that can back it. Right? It's the same principle as a fractional reserve bank account. Everybody knows that if everybody tried to take out all their money at once, it wouldn't be there. So everybody knows that if gold, silver futures traders tried to demand delivery on their contracts all at the same time, it wouldn't be there. It's inflation, but it's sort of like a mirror. It's like a mirror image of it that accomplishes the same goal, but suppressing the monetary exchange rate between the dollar and its substitute, right? But the minute that it was Jeff Curry or Jeff Christian, one of the Jeffs, he said like, okay, so if the COMEX defaults on its gold and everyone calls for delivery and somebody doesn't get it, right, then fine, they can settle in cash. All right, technically, sure, they can settle in cash. But then what happens when this inverted inflationary thing of contracts below an actual gold supply becomes revealed? The dollar becomes worthless. You can settle in cash, the cash isn't going to buy you anything. Forget it. Because that means the dollar can no longer be exchanged for physical gold. That's the definition of it, right? That's the futures trading is dollars being exchanged for physical gold. But so very few are actually exchanging it that when the COMEX runs out or whoever's supplying this stuff, everyone's going to panic. And the dollar's going to be abandoned completely.
So how do ETFs unallocated and pool allocated accounts serve as a trap of monetary demand, Rafi?
So unallocated, and I'm going to be careful here. I don't want to accuse anyone of fraud. Right? I'm not accusing any unallocated operation of not being backed by anything. So the danger of an unallocated account is that it's supposed to notionally be backed 100% by physical gold and silver, by raw material that flows through the mint. The reason that mints sell unallocated positions is because it gives them free inventory, and it works. And the danger is that when the dollar or whenever the paper currency is failing as a gold and silver substitute, and everybody calls it in at the same time, how are you going to get it? How are they going to send it to you? In order to send it to you, they have to fulfill orders. What they do is they have an order flow, right? And so they got to fulfill their allocated first, and then they expect more raw material to flow in through the mint, which then they can fulfill your order if you're unallocated. But you have to rely on the assumption that they'll get more and more of this material as the monetary medium is collapsing. How's that going to happen? It's not going to happen. So what we need to do is we need to reveal the true exchange rate between gold and its substitutes. And the only way you can do that in the real world is by buying physical gold and silver and storing it somewhere, right? Not unallocated. And pool allocated would be better, assuming that there's no fraud. But the best way to do it is to just get the gold off the market. Get it off, put it in your monetary reserve somewhere and sit on it. and force that exchange rate to be revealed.
So, Rafi, something that kind of came to my mind as I was finishing this article and, reflecting upon it was that, it really seems that we're on a path to MMT, right? Modern monetary theory, UBI, whatever you want to call it. So I want to get your take on how this actually widens the wealth gap, or if that's the effect that ends up happening.
Well, we don't have to call it MMT. I mean, we call it that because that's the parlance that's been infecting our culture for the last, 5-6 years. They call it MMT. There's nothing, it's the same, it's just printing money over a gold supply. It's the same thing. It's just, I hesitate to make, totalitarian or Nazi analogies or anything like this. But, in the 1930s and 1940s with Jews, what they would do to delegitimize Jews is that, they would introduce phrenology and measure our skulls and say, well, we're not really human and we carry diseases. And it would infect itself into the academic circles and sound, scholarly. That's sort of anti-Semitism. But, money printing, it's the same evil because it's all lies. I mean, you can't create value, just like all humans are equal and there's not ones that are worse than others. That's also true because we all have God-given rights, or whoever you think gave it to us, and it doesn't make a difference. MMT is just lies. All these lies, what they do is they enrich the people who are able to create these gold substitutes, because creating gold substitutes extracts the gold value. It's the act of spending that money into the system is what extracts the value. So the more that they drug the public into thinking that they should print, the more value they are able to extract from that currency. And the first people to get that substitute to spend it into the economy are the primary dealers of U.S. Treasuries, the Federal Reserve, the central banks. These are the people that are in charge, and they amass more and more and more value. And you see it as their balance sheets get higher and higher and higher, and they hand out bailouts to the banks. And these are the people that get richer and richer. The financial system gets richer and richer, while the actual economy leeches off of get poorer and poorer. So the act of extracting value from a gold substitute, when people only have the substitute and not the actual money, that is what widens the wealth gap. That's what does it. MMT.
Excellent, Rafi. Do you have anything else you'd like to share with our audience as we wrap up here? Tell people where they can view the article and, sink their teeth into it, let's say.
Yeah, well, I suggest putting a link to it in the description here. It's called Gold is Money, the Dollar is a Gold Substitute, and Fiat Money is Impossible. What I wanted to impart with this article is that we have to understand as a community what money is and why the dollar is not fiat. Gold is money now. When you spend $1 in a store, when you spend $5 on a pack of gum, I don't know what prices are anymore, whatever it is, you are spending gold. Right now you're spending gold because you're spending a functioning gold substitute. Bitcoin, it seems to me, and I'm not against Bitcoin. It's fine to have Bitcoin. It's not an immoral thing, but we have to understand what money actually is. And everything goes back to gold because of the regression theorem. That's the logic of what money is. That's how goods and services are distributed on this planet. So if we can agree on that and we can get people like John Adams is trying to do, like to stop with this gold and silver tracking tools. And look, I also own some gold and silver ETFs. It's fine too. I'm not against them. I'm not against unallocated. I'm not against allocated. But the priority should be to save yourself, protect yourself and your family and your loved ones and your neighborhood. When they're going to need a monetary medium, they're not going to want shares of GLD, your PSLV, SLV, and all this stuff, because you cannot get physical gold from that. You'll be able to redeem it in dollars that can buy you nothing. That's the problem. That's what's going to be. So you need to have your physical pile of gold and silver or both somewhere safe. And once we do that, if we all do that, we will be able to close this gold window for good and demonetize the dollar and end this enormous abuse of government power that just keeps getting worse. Look, we're in a lull right now. At least I'm feeling it in Israel. I was just telling you about how I was able to go to the pool for the first time without having my nose stuck, a Q-tip stuck in my nose for a COVID test, which I've never submitted to a COVID test. I've never had it. I did not take the vaccine. I'm not against that stuff. If you want it, take it. You can edit this out if you want. Sorry. But yeah, look, what you need to do is you need to have a supply of physical gold and silver for you and your loved ones and your family. And the act of doing that is going to make you rich in real terms, and it's going to help close this window and stop this tremendous abuse of power, because the biggest power that government has is the power to extract value through money printing. Once they do not have that anymore, they have nothing. And they have to go back to our consent. We have to force them to go back to our consent by preventing them from extracting any more value from us through printing the monetary medium. And the only way you can do that is by buying physical gold and silver and storing it.
Excellent, Rafi. Like we mentioned, we'll link to your article in the show notes, and also you're available on Twitter at Rafi Farber.
Yes, in the Endgame Investor, just Google the Endgame Investor, and you'll get more monetary theory like this. That's what I concentrate on, and a little bit of trading.
Excellent. Rafi, thanks so much for your time today and sharing your thoughts with us.
Welcome, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.